combining even more things together now. Looks like we're still going good. Hopefully audio and visual is still good for everybody. But I'm going to keep on rolling through this. We don't have too much more. I don't want to drag it on too much, and then I want to open up to some questions and some feedback potentially. So let's go. Next thing is the MACD, right? So moving average, convergence, divergence. So we kind of touched on this when we went over the SMA, right? The simple moving averages. So you can already see down here, it looks like we have some SMAs going on. You can also see that, we have the 12 and the 26 going on right here. This is a typical, typically the most used for a MACD. And what the MACD is doing, as you see down here, it's showing the relationship between the two moving averages. And for a lot of people, that's going to give them a buy or a sell signal. And actually, we're looking at Facebook again. And, all right, thanks, JJ. Yep, sweet. Just want to make sure we're still good. Excuse me. So MACD is actually pretty cool. I used it a lot when I was day trading a couple of years ago, when I thought I was like this pro Tim Sykes kind of guy, right? That didn't work out too well. So now I swing primarily. If you were interested, I swing trade. I hold for days and weeks and months. Nothing less than that. And it works out the best like that, but you got to find what works best for you, right? So let's see here. Boom. All right, so we got our MACD here. We were looking at the simple moving averages before. You'll remember that we had a crossover between the 50-day moving average and the 200-day moving average, and that was showing us a long-term price change, right? So that was 50 and 200. Now we're all the way down to 12 and 26. Excuse me. So 12 and 26 is clearly a lot less of a time period. So this will be constantly, crossing over and crossing back over. So let's take this one right here. This is a really good example. You have a crossover here, and you have a crossover here, and this is going to help run a point home that I started this presentation out with, right? So we have our 12 on top, our 26 on bottom, right? Because the longer day moving average, in this example, the 26-day moving average is clearly that price is going to move slower because it's a longer average, bigger average. And the 12 is, less than half. It's going to move a lot quicker. So we have a pivot point here. Our 12 goes over top our 26. And, it happens a few times here, so you got to be careful. And this is where you got to use a bunch of different indicators together, right? But you're watching it here, it doesn't pan through, it comes back, you're watching it again, and it crosses over pretty good. And then, lo and behold, me, I'm going to be drawing support and resistance like it's my job, because it's what it feels like. I'm pretty sure probably 100% of the people in this group here that trade crypto and coins and stocks, it's their second job. Hopefully it's some of you guys' first job, and I'd love to shake your hand. Hopefully I can get to that one day. But support and resistance here, boom. Hopefully you drew that before I drew it in your head. I just want you guys to get in the habit of doing that. So you have the support and resistance here. Like I said, you're using multiple indicators together and thus becoming a crypto god, stock god. I've been on a crypto kick lately. So you are seeing this is coming off this resistance repeatedly. 1, 2, 3, 4 times. And then this fourth time, it breaks out on this long candle, right? And you also have this crossover. You're like, that's sweet. All right. Now we broke this resistance, and it crossed over. If you were probably a pretty comfortable trader, I would say you probably had a limit buy set for this 158 or 159 right here, right? Hopefully that makes sense. So you have that price just sitting there. You have a buy. I want to buy 100 shares of Facebook at 159 because it's right above that resistance. Bounces up to 158, bounces up to 158. It never goes through, but that one time it breaks through, it's going to automatically buy for 159. Your MACD crosses over, confirming that is a change in price or momentum shift, really, and you just ride it. So once again, you ride it, it gaps up. Holy crap! If you get scared, you sell it. More than likely, you're not going to sell it there. It's going to come back down, and as it drops back down, you're probably going to start getting sweaty because these candle wicks are getting low down here. Don't freak out. But then you see not until this other crossover here, then you're confirming that, yep, the price is staying low for at least a little while, but then it crosses over down here, so that's where you want to sell. So like I said, I'm going to hit home a point right here. The point I'm hitting home right now is that you are never going to buy. It happens, but for the most part, I'd say 95% of the time, you're never going to buy the bottom. You're never going to buy the top, right? So clearly you're not buying at this support level right here. You're buying right here. You're playing from 159. So what is this right here? 168. So that's a pretty good move. I'm not going to do that math in my head right here, but I would take that green any day. And that's a pretty comfortable trade right there between using the resistance, using the support, using your MACD to confirm a breakout. And the Bollinger Bands are there. Just I like seeing them there. It's too naked without the Bollinger Bands. So hopefully that MACD makes sense. Let's see. JJ's got a question. If you miss the breakout, at what point do you not buy into it? Whew, that's tough. It kind of matters to what kind of risk taker you are, I think, with a trader. Typically, my rule to myself, at least, is if a stock or a crypto or like a coin is moving too quickly, I'm not going to get into it. It's just a very safe way to do it, but the safest trade is no trade. I know that I've been burned so many times over the last couple of years that I've made that rule for myself. The safest trade is no trade. You know, if I'm feeling really too weary, I'm just going to hold back, and I'll be a lot more happy that I stayed the same price in my net gains than lost a lot, because it's a lot harder to make back money that you've lost than it is to gain money. That's a completely different tangent, but the math actually works out. I guess I should go off on that real quick so that makes sense, or else you'd be like, what the heck is this guy rambling on about? But say you have $100 that you're trading with, and you lose $5. Now you have $95. So you've lost 5% of your $100. But now you have $95. If you gain 5% of that $95, you're not going to have $100 again, because you'd have to have $100 to make $5 back, because that's a 5% move. So that's just a quick scenario on how that if you're losing money, it's harder to gain back that lost money. And if you make money, it's easier to make more money, clearly. So now if you have $100 and you gain 5%, you have $105, and now 5% of 105 is more than $5, and it just snowballs either left or right, depending on how good or bad your trades are doing. But hopefully that little tangent makes sense. And I've seen a lot of traders use the MACD in relation to the RSI. So like I said, it just depends on what works best for you.